A market top is one of the most fascinating and treacherous environments in the entire financial landscape. It is analogous to reaching the summit of a great mountain after a long and arduous climb. The air is thin, the views are breathtaking, and the feeling of euphoria among those who have made the journey is almost palpable. It is a moment of peak optimism, a time when the future seems limitless, and the possibility of a decline feels like a distant and irrelevant concern. But it is precisely here at this zenith of positive sentiment that the greatest danger lies. For the vast majority of market participants, the summit is the point of maximum financial risk, a place where fortunes built over months of careful climbing can be destroyed with catastrophic speed. But for Richard D. Wyckoff, a market top was not a place of peril to be feared. It was a laboratory to be studied. It was the unique environment where he could observe the actions of the great informed financial interests, what he termed the composite operator, in their purest and most revealing form. He understood that a top is not a singular random event. It is a process. It is a slow, deliberate, and meticulously engineered campaign conducted by the smartest money in the world to distribute their vast holdings to a willing and eager public. Through decades of tireless observation of the tape, Wyckoff identified a distinct sequence of events, a series of telltale symptoms that, when understood, serve as definitive proof that the market is preparing not for a new ascent, but for a long and punishing fall. This is the anatomy of that process. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't going well. The first definitive proof that a healthy, thriving uptrend is in jeopardy is the appearance of a fundamental change of character, which is then confirmed by a decisive stopping action. A healthy bull market has a distinct personality. Its character is one of effortless progress, of consistent and orderly advances. On a chart, this is reflected in price bars that have wide, healthy spreads that consistently close near their daily or weekly highs, and that show a clear upward trajectory with only minor and shallow reactions. There is an unmistakable ease of movement to the upside. The very first piece of evidence that this long-established and healthy condition is beginning to erode is a subtle but noticeable shift in this behavior. This change of character can manifest in several ways. The previously effortless upward progress may become labored and difficult. The price spreads, once wide and dynamic, may begin to narrow, indicating that each step higher requires a much greater struggle. The price bars, which once stood distinct and separate, may begin to overlap significantly, a clear sign that the market is no longer a one-sided affair, but has devolved into a two-sided battle between buyers and sellers. Volatility may also increase dramatically. The calm, orderly advance can give way to sharp, erratic swings in both directions, a symptom of the conflict between large professional interests who are beginning to sell and the still enthusiastic public who continue to buy. This change in the market's personality is the first symptom, the initial, often intuitive, warning that the underlying strength of the trend is beginning to wane. This subtle shift is soon followed by the first piece of concrete, undeniable evidence, the preliminary supply. This event marks the first time that a significant, concentrated block of institutional selling enters the market to check in advance. As the stock attempts to rally, it is met with a wave of selling that is far more powerful than anything seen previously in the trend. On the chart, this is often represented by a rally that occurs on a surge of trading volume, but which stalls and fails to make significant upward progress. The price may churn, struggling to move higher, and the bar will often close in the middle of its range or even near its low. This is the footprint of the composite operator. He has begun his campaign. He is using the public's enthusiasm and the momentum of the uptrend as an opportunity to begin feeding his large line of stock into the hands of willing buyers. The preliminary supply is the first definitive proof that a formidable and intelligent opposing force has entered the field. The culmination of this initial stopping action is the buying climax. This is the single most dramatic and revealing event in the formation of a market top. It is the apex of public euphoria, the point where all caution is thrown to the wind. The news surrounding the stock is invariably wonderful. Earnings reports are spectacular, analysts are issuing bold price targets, and the public, swept up in the speculative frenzy, is convinced that the stock is a can't-lose proposition. They buy with an abandon that borders on madness. The chart reflects this climax of emotion with a day or week of extraordinary activity. There is a surge to a new high on climactic, often record-breaking volume, and the price spread for the session is typically very wide. To the amateur, this looks like the ultimate confirmation of strength, a powerful breakout that signals an even greater advance to come. But the professional Wyckoff analyst sees the truth hidden within the action. He observes that despite the incredible volume and the sharp thrust to a new high, the price fails to hold its gains. The bar for the session closes not at its peak, but significantly lower, sometimes even in the bottom half of its range. This is the irrefutable proof. The tremendous, euphoric demand from the public was met, and ultimately overwhelmed by an even greater, invisible torrent of supply from the composite operator. He used the public's buying panic as the perfect cloak under which to distribute a massive tranche of his holdings at the best possible prices. The buying climax is the definitive proof that a great transfer of ownership has taken place, from the strong, informed hands of the professionals into the weak, emotional hands of the public. This event marks the successful completion of Phase A of distribution, and it is the first great pillar in the logical case for an impending market decline. The second definitive proof that a market top is in formation is the evidence that the market is now building the cause for a subsequent markdown. After the violent and emotional crescendo of the buying climax has successfully halted the uptrend, the market enters a new and entirely different phase. It transitions from a state of clear trend into a state of tenuous equilibrium, forming what is known as the trading range. This is Phase B of the distribution process. The amateur, seeing that the price is no longer falling, often mistakes this sideways action for a healthy consolidation, a simple pause before the next great leap upward. But in reality, this trading range is a theater of war. It is the arena where the composite operator conducts the bulk of his distribution campaign. This period of sideways action is the cause being meticulously constructed for the great effect, the long and sustained downtrend that is to follow. The primary objective of the composite operator during this phase is to sell the maximum possible number of shares at the highest possible average price, and to do so without causing a premature collapse in the price. To achieve this, he must engage in a masterful campaign of deception. He knows that the public is now conditioned to buy the dips. Therefore, whenever the price falls toward the lower boundary of the trading range, he will provide just enough support to stop the decline, creating the illusion that the stock remains fundamentally strong and that powerful buyers are still present. This encourages the public to continue buying on weakness. Then, as the price rallies back toward the upper boundary of the range on this manufactured optimism, he will meet this rally with a fresh wave of his own supply, selling into the public's buying and preventing the price from breaking out to a new high. This process of selling on rallies and supporting on dips creates the characteristic choppy back-and-forth price action that defines the trading range. It is an environment deliberately designed to be confusing and frustrating. It is during this phase that the composite operator performs the critical task of absorbing the market's remaining demand. Every share that a hopeful member of the public buys is a share that he is able to sell. The significance of time during this phase cannot be overstated. A quick, narrow trading range implies that only a small amount of distribution has occurred, and the subsequent decline may be shallow. However, a long, broad, and extensive trading range, one that lasts for many months, is proof that a massive cause is being built. It is evidence that the composite operator has an enormous line of stock to distribute, and that he is taking the necessary time to do so carefully. The longer this process continues, the more shares are transferred from strong hands to weak hands, and the more severe and sustained the subsequent decline is likely to be. The patience to sit and observe this entire process, to watch the evidence of supply appearing on each rally, and to resist the temptation to participate in the meaningless and treacherous swings within the range, is a hallmark of the professional speculator. He understands he is witnessing the painstaking construction of a great cause, and he waits for the undeniable proof that the work is finally complete. Now that we have established the initial boundaries of the battlefield, the trading range that forms after the uptrend has been decisively halted, we must transition from the role of a strategist observing the grand campaign to that of a detective conducting a forensic investigation. The first two proofs confirm that the market has entered a state of equilibrium, a prolonged and consequential war between the great informed interests who are selling and the still optimistic public who continue to buy. The next stage of our analysis requires us to read the subtle signals and study the small skirmishes within the confines of this range, for it is here that the most astute observers can find the definitive proof of which side is slowly but surely winning this hidden war. The third definitive proof in our anatomical study is the accumulation of signs of weakness within the range. Long before the final catastrophic break to the downside, the market will present numerous, subtle clues that the forces of supply are beginning to gain a decisive upper hand over the forces of demand. These are the internal hemorrhages, the hairline fractures in the market structure that are invisible to the amateur who sees only a sideways market, but are glaringly obvious to the trained Wyckoffian analyst. The most powerful and intellectually elegant of these internal signals is the divergence between effort and result. This is a core principle of the Wyckoff method, a universal law that states that a healthy price move requires the harmony of effort, as measured by volume, and result, as measured by the extent of the price movement. When this harmony breaks down, it is one of the most reliable forms of proof that the underlying market dynamic is changing. During the distribution phase, we can observe this divergence with stark clarity during the rallies that punctuate the trading range. After an initial dip, the public, still conditioned by months of a bull market, sees an opportunity to buy the dip. Their renewed enthusiasm pushes the price back up toward the upper boundary of the range, and this buying generates a significant increase in volume. This surge in volume is the effort. The amateur trader sees this high volume on a rally and interprets it as a sign of strength, a confirmation that the uptrend is about to resume. But the professional analyst completes the equation by examining the result. He observes that despite this tremendous expenditure of buying energy, the price struggles to make upward progress. The daily price spreads may become narrow and labored. The rally may stall out and fail to even reach the previous high of the buying climax. In its most damning form, the stock may push slightly higher on a massive volume surge, only to close the day with minimal net gain, the price having been beaten back down by an invisible force. This is the definitive proof of distribution in action. The great effort is failing to produce a significant result because it is being met by a wall of silent, persistent, and overwhelming supply from the composite operator. He is calmly and methodically feeding his shares into the public's waves of optimistic buying. This inharmonious relationship is the market's own confession that the demand is being absorbed, and that the stock is now too heavy with supply to advance any further. This concept is further confirmed by a clear structural change within the trading range, the appearance of lower highs. In the initial stages of a distribution top, the rallies may be strong enough to carry the price all the way back up to the level of the buying climax. However, as the composite operator continues to distribute his shares, and as the purchasing power of the public is gradually exhausted, each subsequent rally becomes weaker than the last. The second rally may fall just short of the first. The third rally may be even more feeble, reversing at a significantly lower point. This pattern of descending peaks is a clear and simple architectural proof that the buyers are losing their strength. Their ability to push the price upward is diminishing with each attempt. It is a visual representation of demand becoming exhausted. This series of lower highs forms a descending ceiling over the market, a structural barrier that proves that the sellers are in control, dictating the upper limits of any advance with increasing authority. Finally, we see the intermittent appearance of sharp, sudden signs of weakness. These are distinct downward price thrusts within the trading range that occur on a sudden spike in volume. While the composite operator will often step in to provide support near the bottom of the range in order to prolong the distribution process and prevent a premature panic, these sharp drops are significant and revealing events. They are moments when the supply being offered by the professional interests temporarily overwhelms the available demand from the public, causing a rapid air pocket in the price. These signs of weakness are proof that the underlying character of the market has changed from one of buoyancy to one of heaviness. They demonstrate that the supply is not only present, but is becoming more aggressive and impatient. Each sign of weakness serves as a tremor, a warning of the major earthquake to come, proving that the structural integrity of the market is being progressively undermined from within. Richard Wyckoff was a brilliant researcher, a market pioneer who dedicated his intellect to decoding the universal laws of supply and demand. His method gives us a powerful framework for dissecting these subtle internal signs of weakness. But we must understand, he was not the only genius who built a fortune in the markets. Other titans like Bernard Baruch, a legendary investor who famously sold everything before the crash of 1929, or Richard Dennis, the mastermind behind the turtle traders, or Nicholas Darvas, the dancer who turned a small stake into millions by developing his box theory, all had their own unique methods for identifying market turns. To illuminate these diverse paths to success, we created our new channel, Trading Insights. We explore the stories, strategies, and philosophies of these market masters and many others. If you want to broaden your understanding of market speculation from every angle, we invite you to subscribe and watch. The link is in the description. The fourth definitive proof in our analysis is the climactic final act of the distribution campaign. It is the composite operator's single greatest masterpiece of deception, a maneuver so psychologically potent that it has been responsible for trapping legions of traders on the wrong side of the market for over a century. This is the upthrust after distribution. This event, which typically occurs in Phase C of the schematic, is a sudden and often dramatic price surge that pushes the stock up through the top of its established trading range, making a new high. It is engineered for one purpose and one purpose alone: to mislead the maximum number of people into believing that the long period of consolidation is over and that the glorious uptrend is about to resume. It is the final, definitive proof of the composite operator's bearish intentions, for he uses this manufactured strength to unload the last of his inventory at the highest possible prices to the most eager and misguided buyers. To fully appreciate the malevolent genius of this maneuver, we must examine the psychology it exploits. Imagine the mindset of the average market participant. He has been watching this stock trade sideways for weeks or months. He has grown frustrated and bored. Suddenly the stock explodes to life. It bursts through the old highs that have capped every previous rally. The tape runs wild. Financial news outlets report the breakout. The fear of missing out, which had been dormant, now returns with overwhelming force. The trader who sold earlier is convinced he made a terrible mistake and wants back in. The trader who has been patiently waiting on the sidelines is terrified that this is his last chance to board the train before it leaves the station forever. It is a moment of maximum emotional vulnerability, and it is precisely this vulnerability that the upthrust after distribution is designed to exploit. The anatomy of a true upthrust after distribution reveals its fraudulent nature. The proof of the deception lies in its immediate aftermath. A genuine breakout would be characterized by a sustained hold above the breakout level. An upthrust. After distribution, by contrast, fails, and it fails quickly. The price is unable to hold its gains above the old resistance, and it swiftly reverses and falls back into the heart of the trading range. This failure can manifest in two primary ways, both of which offer conclusive proof of its deceptive intent. The first is a high-volume upthrust after distribution. In this scenario, the breakout to a new high occurs on a massive spike in volume. This is the climactic final transfer of ownership. The huge volume is the record of the public's frantic buying being met by the Composite Operator's final, massive offering of stock. He uses their breakout buying frenzy as the perfect liquidity event to complete his distribution. The subsequent rapid failure of the price is the proof that the buying power has been exhausted and that the market is now saturated with supply. The second and more subtle variation is a low-volume upthrust after distribution. Here, the price pokes its head above the old highs, but does so on conspicuously weak anemic volume. This is the proof that there is no genuine professional demand behind the move. It is a hollow engineered maneuver designed primarily to trigger the stop-loss orders of short sellers and to entice the most gullible of buyers. It fails immediately because there is no real purchasing power to sustain it. In both scenarios, the critical evidence is the failure. The inability of the stock to accept the higher prices and its swift rejection back into the prior range is the definitive proof that the entire move was a sham, a final, masterful trap set before the curtain falls. We have now reached the final stage of our anatomical investigation. We have meticulously gathered the preliminary evidence. We witnessed the change of character and the climactic stopping action that first arrested the great bull market. We have patiently observed the long and deceptive process of building the cause within the trading range. We have scrutinized the internal signs of weakness and seen the proof of supply's growing dominance. And we have analyzed the Composite Operator's final masterful act of deception, the upthrust after distribution. The case against the market's health is now overwhelming. All the hidden internal evidence has been collected. All that remains is for the market to deliver its final, public, and unequivocal verdict, the ultimate confirmation that the long period of preparation is over and the new, great, downward trend is about to begin. This brings us to the fifth and final definitive proof in our sequence. The confirmation, which is comprised of the breakdown of the market below its support and the subsequent test at the last point of supply. This is the transition into Phase D and Phase E of the Wyckoffian schematic. This is the moment when the market can no longer conceal its profound and pervasive weakness. The long period of carefully managed equilibrium, where the Composite Operator supported the price to facilitate his selling, is now over. His inventory is sold. He has no further interest in holding the price at these elevated levels. The floor that has supported the market for weeks or months is about to give way. The decisive break of this support, the cracking of the ice, as Wyckoff would say, is the ultimate irrefutable proof that the campaign of distribution is complete and that the forces of supply are now in absolute and total control. The initial component of this confirmation is the breakdown itself, which is the most powerful type of sign of weakness. This is the event where the price decisively violates the support level of the trading range. For this breakdown to be considered authentic and definitive proof, it must possess a specific character. It should not be a tentative or hesitant dip below the support line. A true professional breakdown is a move of power and authority. It should occur on a wide and dynamic price spread, with the price bar for the session closing at or very near its absolute low. This demonstrates a clear and urgent desire on the part of sellers to liquidate their holdings and a conspicuous absence of any meaningful buying support. Furthermore, this powerful downward thrust must be accompanied by a significant and decisive increase in trading volume. This surge in volume is the critical evidence. It is the footprint of large, informed interests now actively pressing the market lower. It proves that the breakdown is not a random fluctuation, but a deliberate and well-capitalized initiation of the markdown phase. This combination of a wide spread to the downside and high volume is the market's unambiguous declaration that the long-fought war within the trading range is over, and the sellers have achieved a total victory. Following this initial and often violent breakdown, the market will frequently offer one final, exquisite piece of evidence for the most patient of observers. This is the last point of supply. After the initial shock of the breakdown, the market may experience a brief, feeble rally or recovery attempt. This rally will typically carry the price back up to the vicinity of the support level that was just broken. This is a critical moment. The old floor of support has now become the new ceiling of resistance. The entire character of this rally is what provides the final damning proof. A valid last point of supply must be a weak, anemic, and uninspired rally. Most importantly, it must occur on conspicuously low and diminishing volume. This profound lack of volume is the market's final confession. It is the ultimate proof that the demand has been completely and utterly exhausted. The public, which bought so eagerly at the highs, has either suffered crippling losses in the breakdown or has no more capital with which to buy. The professional interests have no desire to buy, as they have already completed their distribution. The market, therefore, is hollow. The feeble rally fails simply because there is no one left with the power or the inclination to push the price higher. This successful test of the broken support on anemic volume is the final confirmation that the path of least resistance is now, without any doubt, to the downside. It is the market's last quiet whisper before the great downward cascade begins in earnest. It is the single safest and most logical point for a professional trader to initiate a short position, as the evidence is now complete, and the risk is at its most clearly defined. Having now dissected the complete anatomy of a market top, we must synthesize this knowledge into a coherent and practical professional mindset. Understanding these 5 proofs is not merely an academic exercise, nor is it solely a tool for those who wish to profit from market declines by selling short. Its primary and most vital function is as the single most important tool for the preservation of capital. The great fortunes in Wall Street are not made by spectacular gains, but by the steadfast avoidance of catastrophic losses. The ability to correctly identify a market top in formation is the key to achieving this. The actions of a professional trader armed with this knowledge differ fundamentally from those of the uninformed public. Firstly, the professional practices selling into strength. As he begins to observe the initial proofs of distribution, the change of character, the buying climax, and the signs of weakness within the range, he does not wait for the final breakdown to act. He uses the public's remaining euphoria and the rallies within the trading range as the perfect opportunity to methodically sell his own long positions, which he likely acquired months earlier during the accumulation phase. While the public is still buying the dips, the professional is calmly and quietly exiting the market near the highs. Secondly, and most critically, the professional refuses to buy. As the evidence of distribution mounts, he ceases to look for new long positions in the market. This single decision to stand aside, to keep his capital in cash, is what protects him from the devastating losses that the public will inevitably suffer when the final breakdown occurs. He has seen the warning signs, and he heeds them. He has the discipline to not participate in the final fatal stages of the public's speculative party. Finally, the professional is patient in waiting for the short. He does not jump the gun and attempt to short the market based on the first sign of weakness. To do so would be to expose himself to the risk of the final, deceptive upthrust after distribution. Instead, he waits with the calm assurance of a detective who has built an airtight case. He waits for all 5 proofs to align. He waits for the final, definitive confirmation of the breakdown and the subsequent low-volume test at the last point of supply. Only then, when the evidence is complete and the probabilities are overwhelmingly in his favor, does he commit his capital to a short position, entering at the moment of maximum strategic advantage. We have just dissected a market top like a surgeon, identifying the 5 key proofs of distribution. But how did Wyckoff develop this incredible foresight? He did it through decades of personal experience, observation, and meticulous study, which he details in his foundational work, How I Trade and Invest in Stocks and Bonds. This book is not just a collection of abstract theories. It is filled with Wyckoff's own stories and real market examples, showing how he navigated treacherous market tops and identified opportunities the public completely missed. To truly grasp the professional mindset required to act on these proofs, you must understand the principles that forge that mindset. This book is that essential guide. The link is in the description. In our final summation, we have traced the 5 definitive proofs that constitute the anatomy of a market top. We have seen that it is a logical and sequential process, beginning with the first subtle change of character and the climactic stopping action, followed by the long and deceptive period of building the cause, then the collection of internal signs of weakness, culminating in the final masterful deception of the upthrust after distribution, and confirmed, finally and irrevocably, by the breakdown and the test at the last point of supply. Let us close with this final thought. A market top is not a single, unpredictable event that strikes like lightning from a clear blue sky. It is a process, a slow and observable deterioration of the market's health. By learning to read this process, by learning to identify these 5 definitive proofs, you equip yourself with one of the most powerful and enduring advantages in the entire field of speculation. You learn not only how to potentially profit from a decline, but far more importantly, you learn how to protect the capital you have worked so hard to build. You learn to recognize the signs that the party is ending, and you acquire the wisdom to quietly exit the room while everyone else is still celebrating, just before the music stops for good.